Will Bitcoin go down after its recent fallback? If you're interested in knowing more about this, please keep watching. Bybit is one of the best exchanges I've ever used. It provides great market depth, a smooth user experience, and an impeccable interface. Click the link below. After completing Know Your Customer, KYC, you'll receive $100 in cash for every deposit worth $100. It's a massive promotion. A limited number of spots. So act fast. Only 3 to 4 hours left. This promotion runs until the end of March. There might not be another cashback promotional event like this again, which had never happened before. You're more than welcome to click on the link below. Let's look at the market of Bitcoin. In this daily chart, we notice an obvious false breakout here. Do you see that? Honestly, I would say the false breakout contains really high risk. Why? Look at this. First, the breakout doesn't follow by trading volume trending upwards. Right? The trading volume shrinks. But the trend before is a real breakout, as strong trading volume exists. But at this point, price action reaches a new peak with low trading volume. Second, it makes a new high. But the increasing amplitude is very small. Really small. How small is the amplitude? The breakout is merely a few $100 more than the previous peak. Just a few $100. It's narrow in the rising space. Let's review the chart. Over this point here, the same case occurs. You can notice a breakout here. It reaches a higher peak. However, the amplitude isn't significant enough. I think this is a very dangerous signal. Let's analyze the example of the previous time period. Let's take several classic and well-known cases. For instance, at this point, it appears a very classic false breakout. It's true that it breaks through to a new peak, but the peak is slightly higher than the previous peak. Just a few $1,000s. You might wonder if this is a breakout of a few $1,000s, while the latest breakout is only a few $100. But they're different. The breakout of Bitcoin over here, with a base price of $67,000. But the current one is around $27,000 to $28,000. The base prices are totally different. $200 and $1,000 have completely different meanings in these two cases. So, the amplitude at the breakout here is significantly small. You can see, this is the starting point of the bear market. It's scary indeed. And also this time period. This is also a very memorable trend for me personally. I still remember that I was eating lunch that noon. The price fell. A big red candle here. Still, you can observe the breakout has risen higher, albeit with a small amplitude. Also, the trading volume is low. Afterward, a retracement is triggered on a massive scale. After the retracement ended, the second wave of bullish price action was shown. Let's continue. We have more cases to review other than these two. There's one more time period. You will realize the same case happens here. Look at this point. There's a new breakout here. A new peak. But the new peak doesn't show much higher than the previous peak. And the trend goes downward then. And this point too, the second breakout. It's grim when the first false breakout appears. But it happens twice. The second breakout marks the highest point before May 19th. It's not considered the highest point of the bull market, but at least of the bullish trend. Before May 19th, it's indeed the highest point. Let's look at the current trend. It repeats the previous trend. A small breakout, with trading volume shrinks, which I think it's a dangerous signal. Perhaps there are different kinds of explanations for this. In the mainstream, there are two explanations. The first one is through the view of futures trading. We notice a new breakout here. Right? It signifies the bullish trend. Hence, many buyers enter the market and go long. After that, when the price falls back, they place stop-loss orders massively, which creates a great power for the price to drop. I reckon this explanation is rather biased. Why? I think the reason is that this situation occurs when the great power or the market follows spot trading. This is my interpretation, which is different from the previous explanation. I think the false breakout indicates a weakening of the bullish trend. As you can see, there's a new breakout here. The price rises substantially. Viewing from this point, the price reaches a new peak, and the rise is even more significant. This new peak must be followed by another uptrend to show that it's a strong upward trend. However, we notice something here. There's a breakout here. Right? The new peak. But the price doesn't increase much. It indicates the bullish trend is actually weakening. We can divide the bullish trend into several phases. This is the first phase, the second phase, and the third phase. From the rising amplitude in these three phases, you can see the uptrend is weakening. This is the weakening signal of the bullish trend. I'm interpreting this from the perspective of a spot buyer. The spot buyers of Bitcoin show a decline in buying powers and buyers themselves. Finally, it leads to consolidation and retracement. As we're reviewing the previous cases, we can see that the funding rate is an anchor used to balance between spot prices and future prices. Hence, spots are the dominant force in the market. It's not about the previous explanation, saying that when a new breakout appears, many buyers enter the market and go long. Then they place stop-loss orders massively, which leads to the price fall. This explanation isn't valid. In the end, the market follows the trend of Bitcoin's spot price. Otherwise, the futures prices wouldn't need to be balanced by the funding rate. Naturally, the spot prices will catch up with it. I believe my explanation is more aligned with the market situation in reality. Okay, let's switch to the 4-hour time frame. We can look at it here. The trend line actually shows an opportunity. For example, look at the breakout. There is where the hedging or short selling should exit, because the breakout gives you a message that the price isn't going down, at least in the short term. At least, it's expected to see a congestion area before the breakdown happens, which makes more sense in the context of this trend. So, this point gives a crucial signal. Let's switch it to a smaller time frame. Everything I mentioned above is the analysis. In terms of trading, how should we study the chart? I would say that don't go long during the bullish trend. For example, we mentioned a breakout at the trend line. Personally, I didn't enter a trade. I've talked about this in the video 2 days ago. It wasn't just today. I didn't enter a trade during this breakout. The breakout of the previous peak should be a point to add to positions. But I didn't get into a long position. Currently, I focus more on protecting my spot position and the profits I've made from it. For example, only when a risk-on or risk-off signal appears, I will hedge, sell short, or whatnot. I think it's the more suitable trading strategy in the current market, instead of going long with high leverage and large positions when the uptrend shows obvious signs of weakening or encounters resistance. Let's look at this pair of candlesticks. They seem ominous. After the price rose, it was immediately engulfed by a bearish candlestick, and its trading volume is well matched with the bullish candlesticks. Hence, this breakout can be identified as a false breakout. It's followed by a weak rebound at the price action and the shrinking trading volume. After that, the price action declines and the trading volume surges. Then, followed by a weak rebound at the price action and shrinking trading volume. Again, the price action decline and the trading volume surges. In terms of the short-term cycle, this trend is more advantageous for a short position than a long position. So, you must be cautious. However, if you go directly short in the current market, it's considered left-hand side trading. Even if we employ left-hand side trading, personally, I will enter the trading in different phases. According to different signals, we can add to 50% of the position, full position, 1/3 of the position, or 2/3 of the position. This is how we diversify the risks. Finally, let's look at the chart of Ethereum. In this chart, this is only one important line. In the 4-hour time frame, the resistance line. Look at this resistance line. Besides, it reflects the fact that Ethereum is relatively a weak market. Why? Because in this wave of rise, it doesn't break through the previous peak, while Bitcoin does. Hence, Ethereum is considered weak in this sense. Please look at this closely and patiently. The resistance at 1,830 USDT. I think this is a powerful resistance. Why? First, we're at this point. Second, let's switch to a longer time frame. The weekly chart, which is a massive time frame. This line has been playing two roles interchangeably for a long time. Look at this, there's a box below the line, right? There are resistances and support around this line. Here's the resistance. It's been playing the roles interchangeably for some time. Hence, this position is definitely an effective one. The resistance here is absolutely effective. Alright, thank you. You're welcome to like and share my videos. And subscribe to my channel. Turn on the little bell button to show me your greatest support. Thank you so much. Bye-bye.
Eyes in the sky, gazing far into the night. I raise my hand to the fire, but it's no use, 'cause you can't stop it from shining through. It's true, baby, let the light shine through. If you believe it's true, baby, won't you let the light shine through?